All right, so the market is hitting all-time highs, right? But let's be honest, it kind of feels like we're all standing at a fork in the road. One path seems to be this amazing new era of growth, and the other, well, it looks like it goes straight off a cliff. So which one is it? That's what we're going to dig into today. We're going to look at this whole situation through two completely different lenses.
And that brings us to the central question, doesn't it? Are these record highs a golden opportunity, or are they a red-hot warning sign? To get to the bottom of it, we really have to understand the two powerful and very different forces pulling the market in opposite directions.
So, on one side, you've got the bears. These are the folks looking at history, crunching the numbers, and basically saying, whoa, hold on, this is totally unsustainable. We've seen this movie before, and trust me, it does not end well. But then, on the other side, you have the bulls, and they're arguing that no, this time is different. They're pointing to powerful new forces like the whole AI revolution that are completely changing the rules of the game and justifying these sky-high prices. Let's dig into each case, and we'll start with the bears.
Okay, first up is what we're calling the valuation lens. This is all about taking a step back from the day-to-day noise, the hype, and asking one really simple question. Based on all of our history, is the market actually worth what people are paying for it right now? And to answer that, we're going to use a pretty legendary tool.
It's called the Buffett Indicator. And honestly, the idea behind it is just brilliantly simple. What it does is it takes the total value of every stock in the market, and it compares that massive number to the country's gross domestic product, or GDP. You can almost think of it as a giant price-to-sales ratio for the entire U.S. economy. It's just a way to measure how much we're paying for stocks compared to the actual economic value being created on the ground.
And look, you don't have to just take my word for it. Warren Buffett himself, the man, the legend, called this probably the best single measure of where valuations stand at any given moment. When arguably the most famous investor in the world singles out one specific metric, you really ought to pay attention.
So the big question is, what is this super trusted metric telling us right now? Well, you might want to brace yourselves because the message it's sending is, it's pretty stark.
As of right now, the Buffett Indicator is sitting at a staggering 219.7%. Just let that number sink in for a second. The stock market is valued at more than double the entire annual economic output of the country. But what really puts this number into scary perspective is when you look at it historically.
So take a look at this table. This lays out the historical danger zones. See that line at 165%? Anything above that is considered significantly overvalued. And where are we? We're at almost 220. We're not just in the red zone, we've blown right past it. This is even higher than the absolute peak of the dot-com bubble. So this brings us to the billion-dollar question. If you put your money in now, at this level, what does history tell you to expect?
Well, based on decades of data, the forecast from this valuation level is a return of, wait for it, negative 0.3% per year. And get this, that's after you include dividends, so you'd essentially be losing money over time. This, right here, is the heart of the bear case. It's a powerful, data-driven argument that the party might be over.
But is it? Is that really the whole story? Is the market just a slave to these historical averages? Or could there be new forces at play here that, this kind of rearview mirror just can't see? And that brings us to our second lens.
Okay, so now let's switch gears and look through our second lens, the catalyst lens. This view, which is being championed by firms like Goldman Sachs, basically argues that looking only in the rearview mirror is a huge mistake, because there are powerful new forces that are fundamentally changing the road ahead of us.
Goldman Sachs has a great way of describing the current moment. They call it a complex yet dynamic investment backdrop. And that's just a perfect description, isn't it? It's not some straight, predictable line. It's more like a swirl of all these intersecting trends, from politics to tech, all bouncing off each other at once.
Just look at a quick snapshot of the last few months. You've got the Fed cutting interest rates, which should be great for stocks, but then, boom, a government shutdown happens, which creates a ton of uncertainty. And at the exact same time, you see this massive AI deal getting signed, which signals a huge tech boom. It's this wild mix of powerful and often conflicting signals. And that's exactly why the bulls argue that the old models just can't keep up anymore. So the bull case isn't about just ignoring the fact that prices are high. It's about finding the specific opportunities that can actually thrive in spite of them. The big question is, where are they?
And here it is. This is the key question from that Goldman report, and let's be real, it's the one every single investor is asking themselves right now. From this point of view, the answer isn't to just panic and run for the hills. No, it's to actively hunt for those catalysts that could drive future growth, even from these crazy high levels.
The bull case really points to three specific game changers. First, you've got lower interest rates, which basically act like jet fuel for the market. Second, and this one is the big kahuna, AI. I mean, the amount of investment and innovation happening in that space is unlike anything we've ever seen. It could literally be creating a brand new economic engine for the world. And third, a potential rebound in company mergers and acquisitions, which could unlock a ton of value that the market just isn't seeing right now.
So here we are, looking at both side by side. You have the valuation lens, totally grounded in history, and its warning of some serious risk ahead. But then you have the catalyst lens, which is laser-focused on the future, and it sees these incredible, game-changing opportunities. You know, the key takeaway here is that you can't just pick one. A smart investor has to do both. You have to respect the warnings from the past while also actively searching for the engines of future growth.
And that brings us to our final thought. In a market that's being pulled between the heavyweight of history and the incredible promise of the future, which tool do you think is more useful for the journey ahead? The rearview mirror, which shows us exactly where we've been? Or the telescope, pointed at what might be just over the horizon?